If you're concerned that being a limited company director will harm your chances of getting a mortgage, in this video we are going to show you how to get a mortgage being a limited company director.
Many banks and building societies have tightened up their policies for lending to limited company directors over the past few years. Often individuals have been rejected at the first hurdle. Disheartening it may be, however, there are still lending options available for you.
If you're a shareholder or director of a limited company with typically more than 25% shareholding, mortgage lenders will class you as self-employed. So even if you take a salary from your business, the lenders will still want to look at your accounts to determine affordability.
The biggest obstacle limited company directors believe they have is proving their income. The good news is there is a number of ways where a limited company director can verify their income.
There are potentially 4 ways for limited company directors to prove their income. The most common way is using salary and dividends. That can be shown on your limited company accounts. It can also be shown on your self-assessment, which is submitted to HMRC. That, accompanied with the tax year overview, is a way that you can verify your income.
Another way of verifying your income is by taking your salary plus your share of profit after corporation tax has been deducted. You may choose not to take any dividends from your finalised accounts at all. That's absolutely no problem. By sending your end of year accounts, showing some profit contained within that, lenders can take that into their income assessment. There are also lenders that will take your salary plus your share of profit before corporation tax has been deducted.
The final way to look at income for limited company directors is through an accountant's reference or an accountant's certificate. That does need to be completed by a suitably qualified accountant, but that is something that a lender can use to show affordability for a mortgage.
If you're a limited company director with typically less than 25% shareholding, the way to verify your income will tend to be payslips. Now, at the lender's discretion, they may ask for further information when they are looking into their income assessment.
So as you can see, there are a number of ways of verifying income for limited company directors. Now, a way of proving that income is normally done by a number of ways. One of the ways is by looking at the full limited company accounts. And those limited company accounts may only show 1 year's worth of trading. It may be that you've been trading for longer, and the lender can also use those previous years. The other way that they can look at it is through your self-assessment. That is delivered to the HMRC, and that will show your salary and dividend. The third way that the lender may want to look at is potentially your business bank statements. Those business bank statements will show how profitable your business specifically has been over the past 3 months. Sometimes the lenders may ask for further information with bank statements and go back further, dependent on whether those bank statements show enough profit to reflect your limited company accounts. It's a common misconception that limited company directors require 3 years' worth of accounts to obtain a mortgage.
There are lenders out there that will potentially provide you with a mortgage with 2 years' accounts or even 1 year's accounts. There may be less lending options available for you if you are looking to get a mortgage with 1 year's accounts. You may expect to pay a slightly higher rate of interest due to the risk you present to the lender.
The next misconception is that for limited company directors, lenders will average the last 2 or even 3 years' worth of accounts.
Even if you have 2 years or 3 years accounts available, there are lenders out there who will use your latest year's income for assessment. Examples of why you may need to use your latest year's income for affordability assessment is because you could have been a new startup. Therefore, in the first year, you've had little or no profits. However, in the second year, your profits have increased. Second example is if the business has suffered during the pandemic. If they have suffered through the pandemic, the lender may ignore the pandemic year and use your latest years for affordability assessment.
We also have a number of queries with regards to age in limited company directors and whether it's possible to take limited company directors past the state retirement age.
If we can demonstrate that the job is a non-manual labour role or there's managers in place to run the business, it's possible to borrow past the age of state retirement.
So as you can see, there's no need to feel disheartened in not being able to get a mortgage as a limited company director.
For more helpful tips on how to get a mortgage, head over to our next video.